Right, no messing about. Let's get straight into the meat and potatoes. Morgan, my guy, we're tackling some proper CMT level 3 gear today, but we're going to make it make sense for the mandem on the street. Volatility targeting. Sounds a bit dry, mate. Why should anyone listening give a toss?
Straight in, no foreplay. I like it. Look, I get it. It sounds like something from a dusty textbook. But listen up,
Yeah?
because this is the actual secret sauce. It's the difference between making it in this game
Right.
and getting absolutely rinsed. And you, mister, I only trade coins with dog faces on them. Oi! You probably need this more than anyone. All you lot know is 100x leverage and inshallah.
Oi, have some respect. In crypto, volatility is the opportunity, bruv. That's where the multi-baggers come from. You want me to what? Target it? Sounds like you want me to cap my own profits.
See? That's the fundamental misunderstanding. You think Vol is your best mate who gets the rounds in. It's not. It's that psycho mate who's a great laugh for an hour,
Yeah. Okay.
but will 100% get you into a fight and leave you for dead. Volatility targeting is your getaway driver. It's about surviving the night. It's as simple as this. When the market's going absolutely mental, you reduce your bet size.
Okay.
When it's dead quiet and boring, you can afford to press a bit harder. The goal is to keep your pound note risk the same every single day,
Right.
no matter what the market throws at you.
All right. Let's put it in crypto terms then. If Bitcoin is swinging up and down, 10 grand in a day, you're saying I should be trading a smaller size than when it's just crabbing sideways for a month between two levels.
Bingo! He gets it. Because a 10% nuke on a small position might cost you $1,000.
Right.
But a measly 1% dip on a massive, over-leveraged position could cost you your entire account. You're stabilizing your P&L. Instead of your equity curve looking like a heart attack, it starts looking like a gentle ski slope. The Dons in the city have been doing this for decades. They just give it a fancy name to charge more fees.
So how are they measuring it? It's not just sticking a finger in the air and checking the vibes, is it? Ooh, the moon's in retrograde, de-risk.
Nah, this ain't your girlfriend's astrology app, mate. It's maths. The simplest way is just looking at historical volatility, the standard deviation of returns over, say, the last 20 days. But that's a bit basic because it treats the price move from 3 weeks ago the same as what happened yesterday.
That's dead. In crypto, 20 days ago is ancient history.
Yesterday is what matters. Preach. That's why you have smarter methods like EWMA, the exponentially weighted moving average.
Okay.
All that means is it gives much more weight to recent price action. What happened yesterday is way more important than what happened last month. And for the real propeller heads in the ivory towers, you got Garch models.
Right.
But let's not even go there. We'll lose half the audience.
Safe. So the big takeaway for the average Joe is this is a tool to stop you getting liquidated. It's all about the drawdown, right? That's the real account killer. I mean, you can be up 500%, but if you give it all back in one savage week, what's the actual point?
Yeah.
That is the magic, Chris. And the numbers are wild. The academic research, the real-world performance, it shows that this one technique can slash your maximum drawdown.
Wow.
We're talking cutting it by a third, sometimes even in half. On top of that, it juices your Sharpe ratio, which is just a city boy way of saying you get more bang for your buck, much better returns for the amount of risk you're stomaching. Hold on, so it's not just about losing less, you're saying it can actually help you make more. How does that even work?
Think about it logically, yeah? If you avoid that 50% drop down that wipes out all the tourists,
Okay.
you don't need to make 100% return just to get back to where you started. You've preserved your capital. That capital is your firepower. When everyone else is broke and crying into their pillows, you're still in the game, ready to reload and buy their tears at the bottom. Yeah. And probably with a bigger size too, because the volatility's starting to calm down. It's a massive psychological advantage.
So it's a system to stop you panic selling like a lemon at the bottom.
And it stops you FOMOing in at the all-time high with max leverage like a complete melt. It's a framework. It takes the emotion out of it. But where it gets really clever is when you stop thinking about just one asset. The real alpha is in rotation.
Ah, now you're talking my language. Like rotating from BTC to ETH when it's lagging, then into some new meme coin that's about to do a 10x.
Sort of, but with a bit more structure than just chasing whatever's pumping on Twitter. This is what the pros call tactical volatility targeting.
Right.
You basically have different buckets of assets for different market regimes.
Regimes? Sounds a bit political.
It might as well be. First, you've got your low vol regime. Everything's calm, green candles, everyone's a genius. That's when you're in your risk-on stuff. For me in Forex, that might be being long Aussie yen. For you, it's probably just being long Bitcoin with a decent bit of size.
Obviously, to the moon.
Then the vibe shifts. You enter the medium vol regime. Things are getting a bit choppy, a bit unpredictable. Your system flashes a warning. All right, Governor, time to calm down. You rotate out of your risky plays and into a safety asset.
Okay.
Instructive. Something that tends to do well when people are scared. For stock guys, that's gold or boring utility companies.
So for me, that's rotating to USDC and earning some yield.
Precisely. And then you have the main event, the high vol regime. This is the crash. Think March 2020. The whole world is on fire. Instead of hiding under your desk and deleting your exchange app, your system has already rotated you into a crisis asset. You could be actively going long volatility, buying the VIX, or even better, you're now shorting the market that everyone's long. You are literally getting paid to watch the world burn.
Mate, I saw this in action. A video from some traders, VTS. They showed how their system rotated them into gold like 9 full days before a massive volatility spike back in August. They were literally making money while the S&P was getting hammered. They were just chilling, completely unbothered.
That's the one. That is the power of a systematic approach. It's proactive. You're not waiting for the crash to hit the news and then reacting. Your indicators are your early warning system. And the best part is, for the retail traders listening, there's a dead simple way to do this without a quant degree.
Go on then. Don't hold out on us.
ATR, the average true range. It's a standard indicator on TradingView on everything.
Right.
It just measures the average daily range of an asset, its bounciness. You can use that for your position sizing. Forget complex formulas. The principle is this.
Okay.
If the ATR is high, your position size is small. If the ATR is low, your position size is big. It's vol targeting right there on your chart. Simple as.
So if I'm looking at some new altcoin and it's going parabolic, the ATR is through the roof.
Yeah?
The smart play is to put less money on it, not more.
Yes! The light bulb goes on. Your degen brain is screaming to remortgage your house and ape in, but the ATR is your sensible mate grabbing you by the collar and saying, "Oi, calm down, son. Let's just put a tenner on it for a laugh and see what happens." It automatically forces you to respect the inherent risk.
That makes perfect sense because a 50% drop on a small punt hurts a lot less than on your life savings. And you see people make that mistake constantly. They follow some guru's advice like always risk 1% of your account on every trade.
And that is one of the most dangerous oversimplified rules in trading.
Wow.
Because your 1% risk on a stable asset like gold is a completely different universe to 1% risk on a meme coin that can rug in 30 seconds. Volatility-based sizing fixes that. It risk weights your entire portfolio so each position carries the same controlled level of risk.
So this whole thing, it's a defensive strategy. It's not a magic crystal ball for finding winning trades.
No.
But it's a professional framework to make sure you survive the game long enough to let your good trades actually play out.
You've nailed it. It's your armor. It won't tell you what to buy,
Right.
but it will tell you how much to buy. And that, over the long run, is what separates the pros from the bust-outs. It's the science of survival.